Christopher, thank you so much for connecting with me today. And I think you have a lot of important information to communicate to people in my network regarding a particular area of tax law nobody has heard about that could potentially save them hundreds of thousands of dollars.
Yeah, or more. Under the
Exactly.
right circumstances.
Yeah, when I came across your website and also all that you've done, I mean, that seems this area, the QSBS, is like your thing. You are like that is what you do all day, every day. You're not kind of like one of those attorneys that does, I guess you would say, everything that comes across the board, right? You focus on this one area, and that is what you appear to be the master of. So,
I knew two code provisions of the Internal Revenue Code, Section 1202 and Section 1045, and I don't know anything else. That's
right.
all I know.
Exactly. And that's what people need. People need the, if you will, the one or two trick pony. That's what that pony does. It does that trick, and it does it all day, every day. Not like the typical tax attorney that says, like, I think I know that. It's like, really? Because if you mess this up, the ramifications here are going to be in the thousands, the hundreds of thousands of dollars or more. And you don't typically find this out until what? It's way too late, right? Because you botched it all up. By the time you figured this out, it's botched up. You needed to find this out early on when you set up the business, as well as when you were going forward making business decisions on what types of business to really be doing and not to doing, because the after-tax consequences are potentially very significant. So let's talk about Section 120 in that the eligibility and what is qualified small business.
Great. Okay. Well, thanks, Jonathan. Yeah. So, I mean, maybe the best way to kind of do is level set here, right? So what QSBS is a code provision. It's Section 1202, as you said, is been in the Internal Revenue Code since 1992, right? So it's been around for a long time, but it's only in the last 10 years, since about 2015, that it really became valuable. And what it says is if you sell shares of stock that meet a certain requirement, and we can talk about all those requirements, then you pay no capital gains tax. You know, at the federal level, and depending on what state you're in, you pay no state tax. So just to give you a hypothetical, let's say I sell $10 million worth of Microsoft shares. I pay the feds 2.38 million of long-term capital gains. Instead, if I sell QSBS for $10 million, I pay zero federal income tax. So the savings are pretty dramatic if you meet those requirements, right? But in order to meet those requirements, you got to satisfy a variety of tests. There's really just sort of 5. There's a lot more than 5, but it's easy to understand. So what the rule says is that you can get this tax exclusion provided you invest in a domestic C corporation. So it's got to be a domestic C corporation. And you get those shares at original issuance, which means you get the shares directly from the company in exchange for cash or sweat equity or property. The company has to have less than $50 million if you invest before July 4th of last year, or now more than $75 million of aggregate gross assets. You got to hold those shares for 5 years if you want to get the exclusion. And then the final rule says that for substantially all your holding period, 80% of the assets have to be used in a qualified trade or business. So it's those 5 elements, right, that you have to satisfy. And it's not that hard. Some of these are more objective and some are more subjective, but, you know, like the first. So it says you got to get the shares of a domestic C corporation. So if, for example, I buy units of an LLC or make an S election, I never get QSBS. Now, I can convert those entities into a C corporation, get QSBS, but I got to get shares of a C corporation. Or let's say I buy a Canadian company, right? I'm never going to get QSBS. I got to get those shares at original issuance, which means I need to buy the shares directly from the company. So let's say, Jonathan, that you hold QSBS, right? You got those shares, and then you sell it to me. I never get QSBS because I don't get the shares directly from the company, right? And so what QSBS says, you got to get the shares in exchange for cash. So I buy the shares, or property. So for example, I've developed this IP and I contributed into the C corporation, take back shares, or sweat equity. I work for a startup or a small company and they give me stock options. I exercise those stock options and buy the shares. Right? So domestic C corporation, you get the shares at original issuance. the company has to have less than $50 million or after July 4th, 2020, $75 million of aggregate gross assets. And that's not value. Right? Aggregate gross assets is defined as the cash and the adjusted basis of assets. So what you're really looking at is how much cash has the company raised, or how much are the assets that haven't been depreciated? When did those go over $50 million? In the startup context, with companies here in Silicon Valley, normally, the early employees certainly get that, and the founders, and then, the venture capitalists come in and invest more and more and more. As I say, once the company's raised more than $50 million, or after July 4th, 2025, more than $75 million, and it can't issue any more QSBS. That ceiling is really like, when is the company no longer small? So domestic C corporation at original issuance when the company had less than $50 or $75 million. And then you have to hold those shares for at least 5 years if you want to get the exclusion, right? So if I get my shares in 2025 and hold them, I got to go out to 2031 and then sell. After OBBA, which came in on July 4th, 2025, now there's if I hold just for 3 years, I can exclude 50% of the gain, or for 4 years, I can exclude 75% of the gain. But at least based on my experience, everybody's going to hold those shares for 5 years, just because, as I say, remember going back to what I said at the beginning, you save 23.8%. So on $10 million, that's $2.4 million of gain. So domestic C corporate at original issuance, when the company has less than 50 or 75 million, hold for 5 years. And then the final rule says, for substantial or holding period, 80% of the assets have to be used in a qualified traded business. That's the most important rule, and why I have a job.
Right, exactly. I mean, because with the other parts, I mean, for example, I think a lot of the people in the drone industry start out as LLCs, but that's not a deal breaker, because you could take an LLC and then convert it over to a C corp. Boom, we fix-a-root it, and that's not an issue.
Actually, certain opportunities. I want to get into that more once we drill down. There's lots of planning opportunities there, right? But let's just cover this last sort of general topic, right? The rule says for substantial taxpayers holding period, 80% of assets used in a qualified trader business. That's super important, because oftentimes when I'm talking with folks, there's this kind of misconception that the company is either is or it's not QSBS. That's not right. The company may meet certain requirements, but it's only QSBS if we know it from the share, right? Because it says for substantial, the taxpayers holding period. I may have gotten my shares in 2021, right, and held those shares for 8 years, and you got your shares, Jonathan, in 2024 and held those shares for another 5 years. And for substantially on my holding period, the company violates these requirements, so I don't get it, right? But you got it, and you held those shares for 5 years, and for substantially all your holding period, the company does meet the requirements, right? In other words, you got to really look on an individual by individual shareholder level to determine whether that shareholder gets the tax benefits, right? So for substantial that shareholders holding period, 80% assets used in a qualified trader business. And qualified trader business is really designed to ensure what Congress didn't want was service industries to get QSBS, right? So there's two important rules. Section 1202E3 says you can't be in certain fields and get QSBS. There's a list of 20 different fields: health, legal, accounting, financial services, banking, brokerage service, a whole bunch of fields, or any other trade business where the principal asset of the business is the skill or reputation of one or more of the employees. Okay, so if you're a drone company making drone parts or building drones, that's fine. You're not providing services. But consider a more traditional tech startup, right? Like a startup that's building something that allows you to broker cryptocurrency or something like that. Are those companies really brokerage services, which is disallowed, or are they really a technology company, which is building the underlying technology? There's a lot of open questions here. I think probably for most of your listeners, this is not going to be an issue. The other important provision is Section 1202E6, which says, and this is really a backstop to prevent service industries from getting QSBS. E6 says that for 2 years, you have this sort of working capital safe harbor where all the cash you have will count it as using a good qualified trader business. But it says after 2 years, no more than 50% of the value of the company can be cash, right? In other words, after I've run my drone company for 2 years, I need to be able to show that if I have $3 million in the bank from doing business, the value of my company, the enterprise value, is $6 million, right? Because that shows that I've created, that I'm not just delivering services, right? I've created this proprietary way to build drones or whatever else it is that creates inherent value in the company. So those are the two sort of important qualified trader business requirements. There's some others. For example, you can't own more than 10% real estate. You can't own more than 10% stock. But those are those are sort of, again, just for people who only can pay attention for 12 minutes, right? The overall requirements. It's got to be a domestic C corporation. You got to get the shares at original issuance. You got to get it before the company is a big company, right? More than 50 or 75 million. You got to hold those shares for a period of time, 5 years if you want to exclude all the gain. And then the company needs to be a qualified trader business for substantial your holding period. The company's assets have to be used in one of these qualified trader businesses.
Yeah, exactly. I mean, so like when I watch some of your other YouTube videos and stuff, like it seems like primarily the first batch of these things, kind of the test. I mean, you pretty much do an analysis almost one time, right? You're a C corp or you're done, right? Oh, you're an LLC. Well, we need to fix that by switching over a C corp and redo another reissuance and fix that. And are you below the amount, right? So, and then the rest of the time is figuring out what to do to get into this, what is the excluded trades, to stay away from those. Potentially maybe you are doing those, you need to stop doing those. And then going forward, there's kind of like this perpetual ongoing aspect of maybe how you want to, from a planning standpoint, always stay within the safe lanes and not get too close to these areas you can get shipwrecked in, I guess you would say. Or if you are in something right now, you could potentially just rehabilitate it.
That's
enough.
Right.
There's such a massive rehabilitation aspect where just as specifically as you just skim over it and go, I can't do this. Well, potentially you may be able to by doing enough of something else, or potentially stripping out that problematic aspect of the business, which is kind of, if you will, like a peanut butter and jelly, because the jelly's there, it's poisoning the peanut butter jelly sandwich. Strip out the jelly and have this other business as a basically doing the peanut butter that is potentially allowed. And so you could, so there's so many different ways to do this. That's what I realized. I'm like, oh my goodness, you are so valuable from just a business planning that somebody should kind of keep you, in the loop on these things, just to understand the business and where to stay away from these problem areas. Where are the gutters that will grab the bowling ball?
Yeah. And I think your point is really valuable as well, Jonathan. Like it's not like, most of the time, we can talk about some of the instances where you can really blow QSBS forever, but most of the time it's fixable, right? And also, I just want to emphasize, as I spend all day long on the phone with folks who are trying to show their QSBS, and it's an edge case, that a lot of this is also just how are you framing what the company does, right? Is the company really more a service company, or is the company more a technology company, right? Or building some proprietary. So, for example, let me just try and give an example that might make sense to some of your listeners. Let's assume that I have a company that does drone cleaning. Okay, we'll come down and wash off your drones and clean them all up. That seems like a service industry, right? That we're just providing a service of cleaning drones, right? But let's say instead, what I say is, hey, I'm not really a drone cleaning company. What I really am is like a tech-enabled drone cleaning company, that we use algorithms to figure out, hey, how can we make sure that when the people go out to clean the drones, they're moving the most efficiently, or people, book online. And what we're really doing is building a platform, right? Some proprietary technology that allows me to clean the drones better, right? Now I've sort of, in other words, converted what arguably is a service company into really a technology company that would be QSBS eligible. Does that make sense?
Yeah, exactly. I mean, so manufacturing of aircraft parts, software as a service, those are in a very safe zone, if you will, right? And then you kind of get into this more very problematic, you're in the iceberg infested waters. How do you carefully navigate that? And that's when you get the consulting. Is that consulting, or is this basically data with lots of automation Is this a service, or is there some special proprietary aspect going on there where based upon our using the going and flying over your solar fields that we determined that these potential these solar panels are at the end of life. They need to be switched out prior to losing this. It's going to cost this here. Right. There's a whole back end of all of this knowledge that you can use to enrich the overall process. What you're not just doing one thing, you're doing probably in reality a whole bunch of other things. And can you take all those other things and then start actually, if you will, beefing those up to where that is a significant portion of your business, which then allows your overall situation to be kind of, QSBS qualified.
That's right. And as I say, it's a lot about how are you telling the story about what is the underlying value of the company. As you say, is it just that you're flying drones over to check solar power, solar panels, or have you built a better way to fly drones that's more efficient or whatever else it is, right? Or cost your clients less? That's QSBS.
Right, exactly. Are you a drone service provider, or are you a website distribution network? Are you a package delivery company, or are you part of an entire transportation logistics market, technology that does the software optimization to determine if we do ground-based, bicycle-based, drone-based, so there, it's kind of like gets you to think definitely broader and like just higher over a bigger area, compared to what most people are kind of thinking what they're doing. And so I think that's where you shine greatly at just saying, nah, you don't want to do that. Let's go and do more effort over here into the software. Tell me more about your software. Tell me about your hardware and what you're doing there to optimize on the back end. What's your value add from the software and hardware? We really want to know about that.
Businesses can change, right? What the business does can evolve, right? You can go, we've had situations where, for example, insurance is one of the listed fields. And we've dealt with companies where, like when they started this company, it was definitely an insurance company. Okay? They just sold insurance. Call it brokerage services, insurance, whatever. Some of these categories that are not permitted. But then the insurance company realized, hey, we actually have these connections. We can build this technology to sell the insurance better. Right? And they built technology. They got venture capitalists to come in and invest. And they evolved into an insurtech company. And we looked at them. We said, well, hey, let's look at the life cycle of this company. Then they sold to the big company, right? And we said, like, hey, look, for substantially all the holding period of most of these people that were in the investors, it was really an insurtech company that unlocks QSBS, even though you started out in putatively one of these disallowed fields.
No, exactly. Yeah, so that's why, I think you are super, valuable. So from hardware, software guys, they would be very wise to start, making sure they stay within their lanes. For certain drone service providers, making sure that there might be a way to rehabilitate maybe what they fell into from a service provision, right? Or maybe that's how they get out of that, that where they are. And additionally, I realize there's a super valuable aspect to you in the sense that you can do a lot at planning the full maximum, if you will, capability on like maybe an exit, timing of exits, how many people, who has what, right? Do you want to own all of that stock, or is there possibilities from a tax planning standpoint to do other things with that stock? Right? Because you're like, you are capped at a certain amount of, right? You're capped at a certain amount of tax kind of exclusion, right? Per person. So there isn't, right? So there's other options there where like, well, what if you have kids and a wife, and there's a lot of interesting other aspects on how to have an exit strategy that is fully potentially maximized for your entire family. So you're kind of, if you will, leaving a legacy. It's not just it's not just you doing an exit. What's the most optimized exit here, potentially for what you're doing. So that's why I realized I'm like, oh, this is definitely super important, especially at the initial phase. At choreographing that, like, what's your exit strategy, right? Because you can tell people how to stay within these certain areas so that the shipping lanes, so they don't hit the icebergs. But what is the actual exit strategy on the back end? Because I think that's pretty much what most people are wanting to do. You're going to do something for a while, and then at some point you're going to try to exit off into the sunset and then kind of retire. And you got these, 3 or 4 year, or 5 year since the recent 2026, updates, right? And so then you need to know that maybe right now, because certain people need to own certain things. Because remember, it's first issuance, right? So that's the major gotcha. And I think a lot of people at the quick point, they're like, well, I can just own it. And then, right, what happens if I transfer it to a wife or a kid? Right? Doesn't that kind of blow the whole thing up on the back end, right?
Yeah, no, that's right. So there's lots of ways to plan into the exit. Maybe should we first go back to the beginning? Maybe just work through, like, should we talk about like icebergs that exist at the beginning, or should we talk about that? Do you want to close the loop here on exit planning and stuff like that?
Well,
it's like maximizing QSBS.
Yeah, it's funny because like, well, I feel like there's like a circular aspect because like I feel like when I started learning about this area, I was like, okay, I think I have a plan, and then it was like, but what about? Because there's typically when you watch this video, right, or whoever, when you learn about this area, you're kind of like, oh, I think I understand it, and then you start coming up with, well, what about this? What about that? And then you kind of like reevaluate the thing, and you're like, whoa. I know we kind of talked about like you initially figured out what you wanted to do at the beginning, but you may want to think about like the family legacy planning exit strategy on the back end, right? With the whole initial issuance. Did you get the original issuance or did the family member? Well, because what if you received it and then gave it to the family member? Then doesn't that bust the whole original issuance requirement? And now you're toast.
Yeah, well, it's interesting. Yeah, so to focus on this sort of the exit planning. So you're right. So and we talked about this, right? You have to get those shares at original issuance. So from the company, you get them. Now, there's this little quirky rule, 222H, says that if I gift shares of QSBS to another taxpayer, that taxpayer steps into my shoes for purposes of the original issuance requirement and for the holding period requirement and everything else. So let's assume I make a cool drone company, right? And we're making these awesome drones that go really fast or do whatever they do, right? And I'm going to sell to Boeing. And again, let's assume I got the shares before July 4th, 2025, just to keep the old rules in place, the 10 million, 10 times basis. So let's say I'm going to sell my drone company to Boeing for $40 million, right? The rule says I can exclude 10 million, right? Up to 10 million, 10 times my basis. And then I would have to pay tax on 30 million, right? That's about $7.5 million of long-term capital gain to the feds. But what 1202H says is that if I gift those shares to somebody else, they get my QSBS benefits. So we'll see founders, for example, going into transactions to sell their startups that are no longer startups, but big companies, right? And I'm going to sell for 40 million. I have 3 kids. So I set up a non-grantor trust for my son and for my daughter and my little son, okay? And I transfer what will be worth 10 million into each of those trusts. Now I've created 4 separate taxpayers who all have the same holding period and all share that original issuance that I got. I sell for 40 million. We pay 0 federal income tax, right? Now, that may be super efficient from a tax perspective. I spend a lot of time trying to discourage people because if you do that, you've given away those, that's not the 30 million that I gave away to my kids' trust. That's not my money anymore, right? That's just for their benefit. So, you have to be careful because you can be super tax efficient, but make poor kind of overall financial decisions to maximize QSBS.
Well, exactly. Your kids might not be wise for the family unit, or it might be depending upon your family unit. So you kind of have to, you have to kind of work.
So another interesting thing, remember, so this, everybody thinks about the 10 million. Now it's 15 million after July 4th with OBBA, right? But there's also the 10 million or the 10 times basis. Okay. Just in terms of like these little quirky rules for QSBS that sometimes people don't know about. There's this crazy rule that says if you contribute property into a C corporation, your basis is set at fair market value. Okay. And so what that means in practice is the following. Let's say I'm going to do a drone company, right? And we've developed this great technology that makes our drones fly super fast and be super efficient and everything else. And let's say that I set up an LLC, because it sounds like a lot of drone folks sort of maybe start as an LLC. If I start out as an LLC, and then I'm going along, and then when my LLC is worth $4 million, I convert it to a C corporation. The conversion of an LLC generally is treated as though you took out all the assets and contributed in those assets in exchange for the shares. So if I form my LLC and when it's worth $4 million, convert it to a C corporation, I've satisfied that original issuance requirement because we're contributing property exchange for the shares. And then I test. Can I exclude the greater of 10 million or 10 times my basis? 1202I says my basis is the fair market value, right? 4 million. I can exclude $40 million of gain because when I converted the LLC to C Corp, it was 4 million. So this is like in terms of planning for folks who start out with an LLC structure, there's actually a real opportunity to kind of arbitrage value to create a step up to do the 10 times basis.
Right, exactly. So in other words, like for people right now, they may not want to quickly switch over. They may want to let it ride a little bit, is what you're saying. Till like, no, don't switch over to C. We're not saying do it now. We're saying talk about doing it now. So talk about these things now, but figure out when it might be optimized to switch over to from an LLC to a C Corp, so you can have the fullest extent of this tax, exclusion, as possible.
Yeah, we now in Silicon Valley, it's increasingly become popular for second or third time founders not to form C corporations, rather to start out as an LLC. And remember, the cap now is 75 million post July 4th, to go out until the LLC is worth 74.999 million, right? And convert, and then take the position that the exclusion is $749 million of zero tax, right? I mean, so it's remarkable, the potential planning opportunities. Now, of course, there's lots of problems that, it's not all rosy. For example, when you do this LLC to C Corp conversion, when you sell, you actually have to pay tax on the value that existed in the LLC before the conversion, right? So in my hypothetical with a $4 million where I convert at 4 million, I can exclude 40 million. That's great if I'm going to sell for 40 million, because I still have to pay tax on the 4 million. I'm really excluding 36. But if I only sell for 12 million, right, then I got to pick up that 4 million. It's not really worth it. So part of this is you got to plan the conversion to be the right time. LLCs in general, at least in the startup world, are very hard. Silicon Valley operates through this kind of C corporation lens and view. Everybody wants options. You can't do that with LLCs. So, and of course, as you run as an LLC, remember, you got to get to 5 years to get the exclusion. So every day that you're an LLC, you're deferring that start date for converting to a C Corp. So the LLC can unlock these amazing QSBS opportunities, but it's not perfect.
Well, right. Some people may just want to be getting out of there in 5 years or less. But I mean, with the recent changes of the law, right? You have the 3 year, the 4 year. So you might be like, hey, man, it's not as bad to do an earlier switch out. But I mean, even from this, I mean, from my understanding, there's also great exit planning strategies with you, because isn't there a capability where you could switch out of one QSBS kind of, right into another business, and then potentially if you had like a side business that you may have enjoyed even more, right? You're like, okay, so like do a little bit here and then exit strategy into another one, and potentially there you could have some exclusions there. So there's an important point on just like choreographing that with you on how to get out of here. Like you got into it, how do you get out of it without Uncle Sam taking all your cash? So,
so remember, I said I only know two code section, right? 1202, right, is the exclusion provision, and then section 1045 is this deferral provision, right? This rollover provision. And for people that are familiar with 1031 exchanges in the real estate context, QSBS has the same rule, right? So what 1045 says is if you've held QSBS just for 6 months and then you sell, as long as you reinvest your proceeds within 60 days in another qualified traded business, then your holding period out to 5 years keeps clicking along, right? And you defer the gain. So let's assume, that I have my drone company and we're going along and I sell for $10 million to Boeing at year 4, okay? And let's say the OBBA rules don't apply, right? We're pre-July 4th, right, 2025. So I sell my drone company for $10 million to Boeing at year 4. If I do nothing, I have to pay tax, 23.8% to the feds on the shares of my drone company. But if instead I take that 10 million and I say, hey, Jonathan, I hear you have this awesome new drone company. I want to invest my 10 million in your company. So I take my 10 million. Now, maybe I wouldn't. I don't know, Jonathan, if I'd invest in your company. But let's just say I believe in you. I do. I take my 10 million. I invest within 60 days. And then your drone company sells 2 years later. Now I've hit my 5 years because I'm able to tack. I had my 4 years. I did the rollover, and then I did 2 years in your company. I'm out to 5 years. Where you've only got 2 years, you won't hit the. You will not hit the QSBS exclusion yet.
Wow. Yeah. And yeah, I mean, there's a lot of great opportunities. I mean, that's what I realized. This is so utterly complex as to getting in and out and where you're going. And you don't really actually know what you're doing 5 years from now, right? This is a very fluid situation. You have like what you know right now for the next like potentially 3 to 6 months. And this is going to evolve. And then you're going to be laying awake at night going, I wonder if, and that's where it's really important to run it by you with a quick 30-minute phone call, right? So that's what I was thinking. Every time you're having like a business idea or something, that would be excellent to just quickly run it by you, because when I realized that there are so many subtle twists and turns to everything the IRS has said over time, where that is incredibly valuable, saying, hey, this was previously in this situation here. These little facts mattered a lot to rehabilitate a problematic situation, or fix a problematic situation, or right. So then you may need to, with your idea, I love it, but we need to include additional pieces of things that you need to be doing so that this doesn't poison the whole situation. And so that's what I realized. It would be really helpful just to have you constantly check for that, over and over again.
Well, exactly, right. And in the end, consider this: that it's you sell your QSBS, you take a position. It's not like the company discloses nothing on its tax return about whether it is a qualified creative business. And in fact, if I'm holding QSBS, I don't mark anything on my tax return or anything else. It's just that when I sell my shares, I check a box on my federal income tax return saying these shares are QSBS. Okay. And so what we spend a lot of time thinking about for our clients is, well, let's say the IRS decides to audit you. How are you going to prove that you meet these requirements, right? And so we spend a lot of time trying to pull down documents or write letters to support these 5 points. Remember the original issuance requirement, right? The 50 million, the holding period requirements, all these various elements. That's what I spend a lot of time doing. The people on my team is just trying to build a record to help support a particular taxpayer's position. So if the IRS asks questions, we can tell that story simply and clearly.
Right. And then also I was thinking there's a great value here in regards to when you build that base of, I think from some of these business owners are thinking like, hey, this is going to be problematic and ongoing cost, a drain to my business, and I'm going to potentially actualize some type of value in 5 years from now. So there's kind of like a depression aspect of like, well, I'm not going to get to enjoy it today. I get that, but there is like a near term, I think, also value to you in regards to if you're dealing with trying to get investors to potentially buy, in some cases. So that I do find that would be right for attracting talent and attracting investors, right? Early on, to see if they can also, right, QSBS status themselves, right? So then,
yeah,
right, because I mean that's what I found very fascinating, because I go, hey, if some service-based company says, hey, I want to like offer you shares or something, I'm gonna go, that's not that great. I'm gonna have to pay taxes on it. But then the right, because when you do a after-tax consequence, there is a lot of value to this, even if you compare it against more higher return on investment businesses, right? You kind of have to get into like when you run an analysis against certain businesses that are QSBS qualified relative to like, let's say, next best alternative like Bitcoin or something like that, or the S&P 500, and you start realizing this is a very interesting after-tax consequence business. And so you can attract certain people or push back on them in the negotiations. And I think that's where you're very valuable at drawing the line and saying, no, hold the line. You are QSBS, you're qualified.
Right.
That
right.
you're more valuable.
It's a really good observation, Jonathan. And in fact, when you look from the legislative history, right, from 1993, Congress produced a pretty good report in 1993 about what their intention was in setting up QSBS. And what that the committee report from 1993 says the reason we're giving this tax benefit, it says, is that we want to incentivize investors to invest in startups because startups generally fail. Okay, so what Congress really was saying is like, hey, look, we appreciate that most small businesses that are trying to build something go out of business, fail, don't make it. So if you invest in one of these companies and is successful, we want you to get this tax benefit. The tax benefit is, in fact, an inducement to incentivize investors to come in and put money at risk on these early companies. Right? Now, from a sort of founder perspective, let's say I'm going to build a drone company, I'm going to do it myself. Like, I'm not an investor, I'm a founder, but it's sort of more like my foregone. I could have gone and worked for Boeing, right? Instead, I decided to build my own company, right, and do this. But QSBS really is about saying, hey, look, if you put your money at risk in one of these little companies, if it makes the moonshot and becomes an IPO or whatever else, we want you to get that tax benefit.
Right. And then also, yeah, the quality, and I've told some of my clients this, like the quality of the paperwork and everything that you do right now determines your potentially, if you're not from a complete exit strategy standpoint, because I think some people think about that, but just like a near term, if you're bringing on other talent and other people prior to hitting the thresholds, how can you basically like set yourself up in the best negotiation position? And that's primarily who has the most paperwork, right? Who has the most paperwork and really also the quality, right? Kind of an overall quality and quantity aspect to document everything. And then being able to also, I mean, if you're able to kind of calculate some of this stuff and that you maintained all this, especially when you get to the upper thresholds, there might be some interesting arguments that you can induce potentially some investors to jump in because, hey, we're about to hit the threshold limit. We're about to, the train, this is, guys, I know you're always like, there's another train, but no, guys, we're about to hit the limit. And this is the last train leaving, and you want to jump on board, you might be able to induce a little bit more at the back end. And here's all our data to prove it. And Christopher put together all this stuff. Here's our notes from Christopher the last 3 to 4 or 5 years. You in or not, because, okay, I have like 3 other offers and they're looking at the same thing, and we only have 1 seat left on that train that's leaving. And it would be great if you was you, but you know what I'm saying? You could hustle back. I always look at it from like, there's always some attorney somewhere that's going to do it. So how can you prep now for the counter hustle, right? Oh, I see your hustle, but I'm going to raise you we have, yeah, Chris, what should we do? Yeah, you should, Chris. Chris is saying like, no, they're lowballing you. You're more valuable. You need to push back on them for, lower ownership or something or whatever, cash or whatever. So I see you as a very valuable person.
I do, for sure. And what also I do, I spend a lot of time just trying to help people remember. This is what I said earlier. Like, remember, it's about how if you take this position, how do you prove you meet all the requirements, right? Like the original issuance requirement. So I spent a lot of time just saying, hey, you got to send me your original stock purchase agreement, right? Or you filed an 83B election because you have vesting shares. Keep track. You don't need to hire me. Like, you just need to keep track of all the stuff to help show that you got your shares in exchange for cash and that you've held those shares for 5 years and whatever else. In other words, it's once you know the rules, or at least understand how they work generally, you can already start to lock down why you qualify. And I think, for folks that are in the drone world, the startup world, or drone operation world, like you can do a real good job of getting QSBS as long as you keep track of all your documents. You don't need me to charge you a lot of money to organize your stuff. Just keep track of everything.
Right, but I think they need you at least on a certain period of time just to kind of, if you will, refresh.
I know when you're selling for 10 million or 40 million, you need me.
Right. I get you on the at the exit. Yeah, at the exit they need you, but there's on the 0 to 5 year. I think that would be wise to just you need them once at the beginning, and then you're gonna need some type of maybe once a year, or 30 minutes for once a year. Just say, hey, this is the current plan. Any issues? No issues. Okay, cool. Moving on. Right, because everybody's evolving, and you need to just reevaluate that new thing evolution as to what's going on going forward.
And have a good accountant. Your company needs to have a good accountant. I think that I always work always as a team, right? And there's always the company accountant. If, for example, you're looking to get QSBS, talk with the CPA who's preparing the tax returns for your company and say, Are you aware of of QSBS? Do you know how this stuff works? Can you make sure that we're meeting these requirements? Right? Because that CPA is going to file your tax returns every year. And so it's important, those tax returns that you file for your company, they tell a story about whether the company is QSBS or not, right? And so that's an important data point.
Well, yes, it's important. I'm always just like a hyper paranoid, so I'm always because remember, it's kind of like that movie Ben-Hur where he's chained to the ship. You know, it's kind of like, look, if the ship goes down, you're going down with it. You as the business owner, if anything goes south, you're getting torqued. You know, you're the one that gets messed over. And what, you're gonna go after that accountant for some, of some sort? What's the policy limits on that? Are you, So I'm just kind of like, you should always double check them because. So that's why I'm like, Chris would be a good person to always keep, in the loop on all these issues. So thank you so much, Chris. You've been super helpful. And if anybody were wanting to get in contact with you, what is the best way that they could get in contact with you?
You can email me. It's best. It's my name, C. Karachale. That's CKARACHALE at hansonbridget.com. That's HANSON, B as in boy, RIDGETT. And Jonathan, I'll send you my contact information. Maybe you can share it as part of the video.
Perfect. Yeah, I'll definitely do that. So thank you so much for chatting today, and hopefully a bunch of people will be contacting you soon. Have a great day. Bye.
Love it. Thanks.